And welcome to the IQ, or as we might want to pronounce it after today's market action, EEK. I'm John Hutchinson with Traders Reserve. I'll be your host for these weekly webinars on Mondays. I want to thank you for taking the time to join me. And we have a lot to talk about today, but I'm going to try to narrow it down to some specifics that I actually want you to pay attention to in the months ahead. Despite the falling off the shelf of the market Friday and again today, there are other issues that we as investors and traders need to be focused on. And that focus is because those issues or these issues will affect us in the next 6 to 7 months. And I'm not worried or focused on recession or recession talk right now, but other things that will come to pass. And how to, over the next several weeks, we'll be working through how to plan ahead and either trade them, profit from them, or protect yourself from them as a trader, as an investor. So a lot to cover today. The doctor is in. If you're worried about today's market sell-off, I'm here to help. But let's get down to our core issues. And I want to talk about what I'll have this each week. I call it the top three. It's my opinion, my top three things that matter to me. And I want to start with the Fed. And I think the Fed's mistake wasn't not cutting rates that's a double negative. Wasn't that they didn't cut rates in July, it's that they didn't cut rates in June. And the labor market has been showing signs of weakening since April. That is, or has been evidenced through non-farm payroll reports, continuing claims, initial claims. It's important to note that, especially on initial jobless claims, they are not in recessionary territory. They have been rising, but the key metric is typically jobless claims above 300,000. We haven't been anywhere near that. The highest is maybe 260. But they are rising, and that is a general concern. But the labor market was one of the biggest issues as it relates to inflation that the Federal Reserve had been battling. But the challenge is you roll the labor market over, you pretty much guarantee you're going to push the market or the economy into a recession. So it's a difficult balancing act, and I respect that. But at the same time, some of those triggers began to appear back in April. I shall note that if you hear toys squeaking in the background today, I have two puppies. Both of them are Yorkie poos. They are Nola and Archie, and they cannot resist the squeaky toys. So if you hear random squeaks, it's not a mouse, it's a puppy. I'm just going to let you know now. Second thing is, as you can see on the two charts on the manufacturing and the services indexes as tracked by the Institute of Supply Management, or ISM, these are monthly index reports that are provided by purchasing managers from companies in the US. And if you just look at it as a stock chart, you see volatile and a declining trend, right? Manufacturing has been in a state of contraction since 2023 and remains so. And puppies squeak again. So manufacturing remains so. And last week printed one of its lowest metrics since the October-November period last year. Excuse me, in contraction since November of 2022. That's a typo on my part. And manufacturing simply has been in a difficult space since or post-pandemic. But until or unless it rises back above 50, which it has only done, I believe, twice in the last 20 months, it remains in a state of contraction. And rate cuts aren't going to solve that by themselves. They will help, but they won't solve it solely or exclusively. Services, however, being 60% of the US economy, are much more important and more indicative of strength or weakness in the overall economy. And services have been in a declining trend. They bounced back up to a positive number for July. That was reported this morning at 10 a.m. But you can see that the April arrows really show you where that loss of momentum in the economy really occurred, right? It's like the first time that a stock drops and then it recovers and you think everything's going to be okay, and then it drops again. And you can see that that's what's happening in certain segments of the economy. It's key to remember that recession risks may be increasing, but we are not in a recession, not in the technical definition. But as I had discussed with folks on an IQ webinar back in June, as we talked back in March and April as part of the 10X portfolio, at some point, bad data becomes bad for markets, and that point is now. And that's evidenced from the market action late last week and again today. In the months prior, the Wall Street has been basically begging for the end of higher for longer rates from the Fed and treating bad news as good, meaning more bad news would move us closer to that initial rate cut, that first rate cut. I will remind you that sometimes you should be careful what you wish for, and I'll show you why here in just a minute. But in stressing that the recession risk may be increasing, the economy is not in one, it's also worth looking at earnings from the most recent quarter. And this is, I pull most of my data from FactSet. And for when I want earnings, the chart at the bottom is from FinViz. But earnings overall, 75% of the S&P 500 reporting, 78% reported above estimates. That's good. Earnings growth on the quarter was 11.5%. That's excellent. In fact, I believe it was the fourth consecutive quarter of double-digit earnings growth. We can see healthcare and real estate had the best overall performance in terms of earnings above estimates, but not in terms of returns for the year. Communications services had one of the worst above estimates performance, but it was one of the top, well, before today, was one of the top year-to-date performance sectors. So what this implies is that earnings are still strong, but we want to balance that against what is happening with estimates. Are they being pushed? Are they raised? Are they lowered by individual companies? We've seen a number of companies decreasing estimates in forward quarters and then beating those lower numbers. That is a risk not necessarily focused on in the financial media enough. Doing a little bit of research ahead of today, one of the things that I discovered is that earnings expectations for the third quarter are minus 2% lower than what they were 90 days ago. So there are decreasing expectations for earnings going forward. Next week, we're going to translate earnings data into a chart on the S&P 500 and see where are the opportunities and the risks as it relates to a chart. But today, what I want to focus on is what does the news actually tell us? In part, the sell-offs that have occurred since essentially late morning, midday Thursday, are data-driven on one hand. Disappointment in the Fed not taking action on the second hand. On the Discord channel today, we talked briefly about whether or not or how what is called the yen carry trade is negatively impacting markets. That may be a part of what's happening. I won't detail or go into extreme detail on that. It's not that it's complicated. I don't think it's necessary. But generally what we had was a largely risk-off day. And that is simply the market is rebalancing. Where is the forward progress in the S&P 500? So as it relates to earnings, generally earnings have been fine. So we can sort of cross that one off the list. And that helps us to get down to saying that it's data. And the manufacturing data has been largely poor for most of the year. So this feels overreaction or at the level of overreaction. And the other thing that I want to point out is with the jobs report having come out on Friday. First of all, you still added jobs. That's a positive. Jobs reports are frequently revised. So the most important report as it relates to the labor market, it will be the report that will come out in early September, the August jobs, and looking at any revision to July. Part of the reaction by the market is due to the June jobs report being revised lower. Originally, June was reported at 206,000 jobs added. It was revised down to 179,000. But if we look back on our non-farm payrolls report here for a moment, that June number is still technically in line with the average jobs produced on a monthly basis. That's what my red line is. My red lines for manufacturing and services are essentially the difference between contraction and expansion, which is measured as 50. So the 50 line on either of those reports determines where either of those sectors are. In order for us to really say we are trending toward or falling toward recession, both manufacturing and services need to be below that red line for a period of time. 1 month is just 1 month. A series of months is a problem. We don't have either of those yet. We do have weakening or slowing momentum. We do have lack of growth in manufacturing, but with services bouncing, does it maintain that level for this current month, as will be reported next month, or does it slide again slightly below contraction as it has done in both April and June? These are the types of things I want to be looking at or looking for before I really feel like we're headed toward a recession. So I don't think we're there yet. However, all of that being said, this is taking a longer view, and two things to bear in mind. The yield curve, the 10-2s yield curve, reached its highest point on Friday. I don't know where the bond market finished today, but at one point they were at essentially zero, where the 2-year and 10-year yields were equivalent, about 3.66%, but they separated in the later part of the morning. But at any rate, Friday's close, the yield curve in terms of basis points was down to a -8. That's the highest level in 2 years, which means that the yield curve at some point in the near future is likely to disinvert. I think the technical term is backwardation. I don't know where they come up with that one, but that is likely to happen. It's worth noting that the S&P 500 does not fare well in the 12 months following positive reinversion, disinversion, uninversion, take your pick. In 2000, the S&P 500 declined for 22 months. In 2007, we all know what happened, right? The S&P fell apart in 2008 and then didn't recover until 2009. As well, market is screaming for rate cuts. Now, the September rate cut projection has moved from what was expected to be a 1/4 point to a 1/2 point. That's panic in the streets. And the S&P 500 does not fare well in the 6 months following a rate cut either. The markets do tend to make new highs in the 6 months prior to that first rate cut, which should sound familiar since we just had a new high had consistent new highs in May, June, and July. So that is following history. Remember, as it relates to markets, Wall Street, trading, etc., history has a tendency to rhyme, but not necessarily repeat. So things may be similar, but not necessarily be exactly the same. But it is still important to recognize where there may be risks to us in or with changes in economic, whether it's economic policy, monetary policy, etc. Markets also tend to underperform in the first 6 months following that first rate cut. As you can see, the table here, which was provided to me by Tom Essay, some of you may know from our past Investors Blueprint Live conferences of the Sevens report. These are the individual sectors performance from the S&P 500, and you can see from mostly 2001, 2007, those sectors were largely negative. So do not be surprised if the S&P 500 is net negative in the September to March period. I also would not be surprised if we see a rebound from current levels in the S&P 500 back to around 54, 54.50. The last gasp before the drowning occurs. And real support right now is probably in the 5,100 range, maybe as low as 5,000 on the S&P 500. So those will be sort of where we mark off what happens when that first rate cut occurs. That being said, bringing this to you, pointing this out to you, it is to prepare you in advance for any possibility. And unfortunately, at the moment, that possibility is a continuation of what we're seeing in the market right now. I don't think we're looking at bear market level. Again, the economy, that data does not support it. Despite what I say, I'm still bullish on this market, although not on one of my stocks, I can tell you that. And I want to review that here real quickly. So we're moving along. I would not be surprised if we have these types of issues in the months ahead. Stocks that take significant haircuts. In the earnings season that we just reviewed, those stocks that missed earnings had a greater tendency to fall by 15% or more. And what I'm going to do is walk through a process that I use when that happens, although in my case, it was a disaster. One of my stocks fell 40% in a single day, and that was following an earnings call, and give you some ways to think through as an investor or as a trader or both. How can you approach that? What can you do? Because even if the market falls apart, stocks that you're holding in the next 6 months, and you suddenly find yourself in the red substantially, you need to have a plan. And we're going to start building that plan. We're going to build it in advance. Now, we're 2 days late and $1 short, or $2 short from Friday's action and today, but we can still plan ahead. And I want to show you the process that I've used here and walk you through this particular stock. That stock is Dexcom, symbol DXCM. When I reviewed the stock back at February's Investor Blueprint Live, it was a stock that I added to my 2024 growth portfolio. And I caught it more or less on a higher price, but in doing the fundamental analysis that I use, using earnings growth rates, discount percentages, which I've talked at length about, we'll review them again in future IQ sessions. I was looking at this stock as having the potential to rise to the 150s, so roughly a $30 gain or 15 to 20% gain for the year. And back at the beginning of the year, I don't think we really believed that the market was going to move towards 6,000 as it ultimately did, much less 55, 5,600. So I was looking for stocks where I could get 15, 20, 25%. But those stocks had solid, strong earnings. They had excellent fundamentals. There was a rationale for buying the stock. And at this point in time, there was one for good old Dexcom. And then they reported Q2 earnings, which overall, the general earnings were a beat. Revenue was a slight miss. They missed by 3%, and the stock fell 40%. But there was a reason, which I'll explain in just a moment. But you can see the stock was largely flatlined through most of the year, most of this year. I bought in just over 120, I think it was 123. And you can see I got up to about 140, so things were looking good. I was on my way to 150, and then the whole world fell apart. So this happens, right? This is the normal ebb and flow of a stock during the course of a year. This is a stock that I was planning to hold for a year at a minimum. And of course, now all plans have to change. So what do you do, right? Your stock falls that much. What do you do? The first step is to evaluate using current data, because all the past data is now useless. So I revalued the stock. I evaluated the stock using the same fundamental process that I use. I started with the current price, which was at the time of this was roughly $72. Current earnings for the current year. But the biggest thing that I noticed, noted in the bullet points on the lower right, was that the earnings growth rate decreased from 30% to 16%. If we go back to my original analysis back in this would have been actually at the end of last year, heading into January. The growth rate at that time, the 5-year growth rate was 30%. Now it's 16%. That's a huge change. The earnings expected actually increased from 143 to 170. On any other basis, that would be good. But that decrease in the 5-year earnings growth rate was a negative to me. The price projection decreased from 156 to $83. That's a problem. And both the current and forward price to earnings ratios fell by approximately 50% each. So the stock is still, what I would say now, overvalued given the net negative changes that occurred following this Q2 earnings report. And the irony, and I think this may be true today as well. I'd have to actually, I can check in the background because it's one of those funny things that happen and you just can't explain it. Yep, sure enough. So Dexcom was on Friday. It's my worst performing stock in this little portfolio of 12 stocks, but it was the only stock that was positive on Friday. And guess what was positive again today? Dexcom. Actually, Elf Beauty was up also, but Dexcom and Elf were the only two stocks that were positive in this portfolio today. You can't explain it, right? So one of the steps to take is to avoid overreacting. It's not easy. It's easy to say. It is hard to do. But you have a stock that falls that far, that fast. Your first step is evaluate with current data and determine why is the stock down 40%. If you can't figure out easily in less than 10 minutes why that stock fell that much or however much, that's a point where you need to move to the stage 3, which is taking action. But in my instance, I was able to determine why the stock went down, and I will cover that here in just a second. But overall, the reason I say to be careful about overreacting is because part of this is what's the overall performance. As of the close on Friday, portfolio was still up 26%. I'm still beating the S&P 500 by 2 to 1. Still taking a beating like everybody. But overall, that performance is holding. So I'm okay with that. What that does is it buys me time to make a decision of what do I do with this one stock. So that brings us to what are my choices? Well, I still need more information. I want more information. First of all, Dexcom is in the healthcare sector, which we just reviewed in earnings. It's one of the top performing sectors for earnings. So there's a basis in saying that the stock should continue to outperform on an earnings front. They had a revenue miss, but an earnings beat in the most recent quarter. And the reason for that revenue miss, which was easy to find because I just read the first couple of paragraphs of the earnings call transcript, was a structural issue. They are in the process of revamping their entire sales force. Well, okay, are they going to solve that problem in 1 or 2 quarters? In my view, probably not. But knowing what is likely the cause, which is lower throughput on sales, less access to doctors for their particular drug platform, et cetera, knowing that it's a structural issue tells me, one, it can be fixed. It's not a product problem. It's a business problem. You can fix business problems. Usually you can't fix product problems without having to come out with an all new product. So, but knowing that it was a structural issue at least led me to the question of, can they fix it in 1 or 2 quarters? The second part of that is, can I actually wait 1 or 2 quarters? And in that case, I want to look at the charts. And in this case, I don't rely on the daily chart alone. I actually take a longer term look at the stock, both on weekly and monthlies. And what I found was that this stock has a very strong support line, both on the weekly and the monthly charts at about the $80 range. Now it was, or is is still trading below that $80 price point, but that gives me a marker that typically a stock that falls that far, that hard, that fast will trade back to a key support line. And it doesn't have that far to go. It's a 10% move to get from 72 to 80. So that's reasonable. And when you look at the current daily chart on the stock, let's go back here, you can see that since that earnings day, the stock has been rising. So that justifies to me that I may want to be cautious about making a decision quickly. But I have more information now that can help me make better decisions. So what are those possible decisions? First is I could do nothing and hope for the best, but that's generally not me. The second is I could sell my shares at a loss. That's also not me. I prefer to at least find a path to uh, organizing a plan to get at least back to break even or reducing my loss to the smallest amount possible. So, which means I could also swap the stock out for another stock. In this market, that would be more difficult to do with the breadth of selling because that being a recent event. Where am I going to put my money? And in my case, it's important to remember that I'm talking about a small amount of capital, roughly $2,000. Well, in the original shares here, about $1,600. So, for my purposes, it's not a huge amount of money. For others, in other cases, right, you may have hundreds of shares, they have thousands of shares. And in that instance, it's a much more challenging path to look at. Do I swap this out? Do I sell shares at a loss? Or do I take a different step and dollar cost average down? Dollar cost averaging down is a step that I advise as a cautious step because the number one thing to avoid is the second leg down, right? If the stock went down 40%, what I don't want to do is walk into a stock that's going to go down another 20% or 10% further, right? Because that makes it even more difficult to get out of the trade or out of the position. In this instance, there is a fundamental basis based on the numbers that I just ran saying that $80 price point is a legitimate price. When I did the evaluation a second time, the 1-year price forward based on current earnings growth rate of 16%, et cetera, I came out with an $82 forward price for the next 12 months. So I have both a chart basis and a fundamental basis in saying I may be okay dollar cost averaging down on the stock because there's both a dual purpose or a dual logic to that $80 price, and I'm not that far away from it. So in my instance, based on what I traded, invested, et cetera, the shares would require additional capital, roughly $900, which would give me an average price, a cost basis of about $96. So the biggest benefit to me in taking that approach in the dollar cost averaging down is that I cut in half the percentage move required to get to break even. If all I did was hold the stock, I'm cutting that in half. So instead of the stock having to rise 71% to get back to break even, it only needs to rise 34%. And in looking at the chart, this stock has made those types of moves in the past. So it is not unthinkable, nor is it unrealistic. The when, of course, would be the biggest problem because we're down at 72, still needs to move $24. We're now in a different market than we were a few months ago. So I'd have to give that even more thought before I pull the trigger. I have pulled the trigger, but we'll cover that here in just a second. The key point to remember here is the last bullet, which is this does mean that I have to commit additional capital for an unknown period of time. I may have a 1-year price of $82, but that doesn't mean I'm going to get there in a year. I might get there faster. I might get there slower. So I have to be aware of that. That doesn't mean this isn't not an approach that should be considered. It simply means we need to know what the risks are. And one of those risks is exposing myself to future earnings reports. Remember that next leg down that I want to avoid. So in part, what I want to try to do is get as close to that break-even point as I can, as soon as I can, because then I can make a better decision about the next step. Am I going to keep the stock or am I going to kill the stock? Which brings me to options. In this particular case, the one thing that I want to make clear is I would not use options buying strategies. And the main reason is I'm risking more capital as a capital loss. I would use option selling strategies because I have more capacity for exiting the trade, rolling the trade, right? If something goes wrong, I have steps that I can take to get out. Even if I have to take a small loss or a loss, it's not going to be the same as, 100% loss necessarily. Maybe, right? Until it happens, we don't know. But what the selling side does is gives me a way to begin to chip away at whatever I have remaining as a net negative debit or net negative cost basis. So in my case, because I don't own 100 shares, the only step that I'd be able to use would be spreads, basic call or put credit spreads. My objective would be to target income as a loss replacement approach or loss recovery, not an outcome trade where you're buying options and hoping the option goes up 100%, 200%, 500%. Because there are too many factors that I would have to get absolutely correct on the buying side. I don't have to be right on the selling side. But my goal initially would be to recapture 50% of my loss. Loss on that stock right now is roughly $600. So my initial goal would be, how fast can I get $300? And if I can target an initial trade or at a trade level, if I target $50, that means roughly 6 trades. That's not a lot of trades. And if I can hit that, then I can hit that 50% recovery. I may be able to do it faster. One of the advantages to DXCM is they trade in 1-point increments on weekly options. And that means that I can use everything from a 1-point to a 1 wide to a 10 wide spread. I can use 1 wides and try to get 15 to 20 cents, which is roughly a 20% return on capital. And I can trade multiple contracts, which would be no different than trading a 5 wide or even a 10 wide, depending on total contracts. But the key is that I can manipulate my capital or my capital leveraged based on what's happening with the stock or with the overall market. So I don't have to be 5 wide every week. I actually have choices here. I can go 1 wide, 2 wide, 3 wide, kind of like a Dr. Seuss trade. But these numbers were weekend aftermarket numbers. So take them with a grain of salt, take them as hypotheticals. But one of the things I was looking at was just at a 5 wide strike, 5 wide set. I could use 2 different expirations. They would have been this Friday and next Friday, and roughly somewhere in the neighborhood of $400 in capital each, with premium of 71 to $1.35. I don't have to capture 100% of that premium. I just need to beat my goal. My goal is $50. So a 75% target on one, a 50% target on the other would get me to those goals. I don't have to make it all back in one trade. I can use a series of trades. In both of these instances, I was also well out of the money, given where the stock was trading or is trading at the present time. I can try to let it run closer to or all the way to full profit if I'm fortunate and that happens, right? If the stock starts running up to 74, 75, and I have a 70, 65 spread, I'm going to let that run as long as I can because I have a better chance of capturing more than 50 to 75% of the initial premium. But the biggest advantage here is if I were choosing between dollar cost averaging down and or using options as a recovery approach, the options is using substantially less capital than buying the additional shares. But I can also do both, which is dollar cost average down and leverage options to recover. Because what that helps me to do is any increase in the share price to that $80 mark decreases my net debit, which decreases the objective. If I want to get $300 back, I'm going to make that and the price of the shares rising combined will help reduce my overall net debit or negative cost basis, right? So what I did was I bought 13 shares at 70, which decreased my actual cost basis to 96.57. So I have one outlying stock here with 26 shares. You can see my net gain is negative 631. So I still have that loss, but I can use both put spreads wisely, cautiously, targeting $50 per trade. And as that stock continues to move toward that $80 per share level, that will help me reduce my net loss to 430. And that's all I have to chip away at. So I can continue to reduce where I have a loss in this particular stock. And as I get closer to less than $200, I may actually just take the small loss, because against the backdrop of my full portfolio of 12 stocks, it's not significant. And if this were a multi-$1,000 loss, that would be different. But in setting the plan, one of the lessons to pass along is to take the time to look at your choices. And you're not always going to get every choice correct. I'm not. I don't expect you to. But if you have a way to look at the stocks in different lights, whether it's owning additional shares, does it make sense? Whether it's using solely options, does that make sense? Whether it's using a combination of approaches, does that make sense? Right? The time that you take to look through or walk through the process will help you to make a better decision. And remember, if you get it wrong, you get it wrong. Make another decision, but don't beat yourself up over it. We all get them wrong from time to time. Got this stock wrong, obviously. I didn't foresee a 40% one-day drop. But at the end of the day, it's about taking the time on the process. So that is a little special lesson for this week's IQ. And I want to take a walk through last week's results. These are closed trades only. We had actually a pretty good week last week, despite the end of the week. And a special note on SPX1, which I'll cover here in a moment. Options Income Weekly had a single trade closed on NextEra Energy, right on that $50 line. Income Masters, you had one put spread on Meta, Facebook close for a 10% return. On SPX1, I'm going to take a moment to talk about that. I'm showing this as a gain solely for the purposes of education. Our alert was a loss. We will track that trade last week as a loss. But Jeff and I spent almost an hour, actually a little more than an hour, monitoring the SPX1 trade last week on Friday after about 2:30. And we started out on 15-minute charts, and we wound up down on the 1-minute chart. And the folks on Discord almost got a sportscasting play-by-play on this trade. We stayed in the trade until the bitter end, although it was a happy end, in part because we wanted to see what actually happened to the options premium on that spread as the trade, or as the SPX oscillated in basically an 8-point range for nearly 60 minutes. So from roughly 2:50 p.m. to 3:50 p.m., if you pull up a daily chart on Friday and go down to actually, you don't even have to go down that far, but you can see it easily. It was a very tight and small range that the SPX was trading in. But each time it would run to the high end of that range, the premium would decrease. We were looking for an exit, but every time we were ready to call an exit, the premium the SPX would run right back down to the bottom end of that channel. And so the difficulty that we had in roughly the 3 p.m. to 3:15 p.m. period was we couldn't get a timed exit. In other words, we couldn't get a 2 to 5 minute stretch where we could get the alert out and the premium would stay relatively stable. Premiums were bouncing anywhere from $2 to $6 in that the 30-minute period from 2:45 to 3:15. Well, we didn't want $6, so that's why we had to keep waiting and waiting and waiting. And by the time we got the alert out, Jeff and I were like, well, let's just stay in it and see what happens the rest of the way. And what ultimately happened was at the end, just about 3:50 p.m., the trade was still bouncing between a small gain and a loss. And then in a period of about 5 minutes, the market ran up from the 330 to the 345 level, and our GTC at 20 cents wound up triggering. So that actually would have been a profit. Now, from a service perspective, we can't realistically make people wait until 3:55 p.m. That's why we put the alert out as a loss. That's why we will track it in our track record as a loss. But I want, for those of you who are able to watch this trade on a day like Friday, they are not all like that. But if you can, and there was not enough pressure after the morning hours below the 53.20 mark. which is why we stayed in it. We did not believe that we were going to retest the 53.15, the top strike in that spread. And it didn't, but we were one contract. So what's the worst that could happen? And hopefully everyone did limit or minimize themselves, but $1.70 loss, we can make that back in 2 weeks at the most, maybe 1 week. May not be this week, but in the next week or two, I don't see that as being an issue. So the part of the lesson in that particular type of trade is patience, although difficult, is sometimes necessary. It's no different with that Dexcom trade that I have to recover somehow. Patience is necessary, but difficult. We're moving forward the rest of this month. Patience will be necessary, but difficult. The S&P will recover. Markets always revert to previous highs. It's just a matter of when. So that's my big lesson for the day. Patience. Don't hit the bottle too hard after today's market action. I promise you better days will happen here. 5K challenge had a really good week. We closed out 3 trades, 2 on the XLK, 1 on the OIH. That's trading technology and oil markets. The second XLK closed in 2 days. The first one was a little bit longer of a trade, but net $1,500 on the week last week for 5K challenge. So for those of you taking part in that, congratulations. That was a good week. And those of you who were part of the July Millionaires Trading Club special trading event, we also closed the ExxonMobil XOM spread, calendar spread, excuse me, I'm losing my voice, for a 10% gain. So that's that session in July from Millionaires Trading Club, 3 closed trades, all of them around 10 to 10.5% gains. I believe we have 1 remaining open on the SPY, which is probably going to be a challenge. But Jeff I think he rolled that out to next month. So we have, or later this month or September. So we have plenty of time to deal with that one. So one of the reasons that I will add this is so that you can see how we're doing across different services. I only focus on closed trades. Open trades, open positions will be handled in your live trading sessions with Dave or Jeff during the week ahead. But this is to give people a look back and also as a way to make sure that if we close something, that you also closed it. So sort of a combined approach of all of our trades for the week across all of our trading services. Last up, upcoming events, things that you'll want to be on hand for. Investors Blueprint Live, we've made a small change for 2025's event. It will be a 2-day event. A funny story, the hotel sent us the Hyatt place in Boca Raton, where we're holding it, sent us their room rates. And I asked Dulcie, who handles our event planning at Traders Reserve, to complain. We've been holding this event here multiple years. Can you please do better on the room rate? They gave us a $4 discount, $4 per night. So I cut half a day. So anyway, the conference will be a little shorter. Instead, what we will do is more pre-conference trading events between November and January, largely, especially on the investing side of the business. And we will focus on trading options this is largely consistent with Options Income Weekly and Income Masters trading during the Investors Blueprint Live event. We'll have plenty of investment stuff for people building portfolios, trading stocks, etc. But we will do more of that in the November-December period in advance of 2025. So you can have a portfolio in place, or at least a plan in place for a portfolio for the new year. So pre-sale tickets will be available a little bit later this month. That's the major change that I want to make sure those of you who will be attending know about. The other thing, Millionaires Trading Club, our August 14th trading event, that's a Wednesday, 10 a.m. to 2 p.m. event. We'll have that available for people who are not yet ticket holders to MTC. You'll have access to buy that single event a little bit later this week. We're looking at alternative SPX options tactics that Jeff has been testing, and an alternative earnings tactic, which Dave has been trading as the backdrop for what we will be doing in the Millionaires Trading Club August 14th event. And then for those of you who are Income Masters members, we will be doing a mini Madness. Remember, Madness is now exclusive to Masters. A mini Madness event August 19th through the 21st. And I think maybe the 22nd. Dave, I think, said he wanted to do a 3-day thing a little bit later this month. So get that out. We'll get that out to you for your August calendars, but just a pre-announcement for those of you who are Income Masters members. And some things we will be talking about in the weeks ahead, sector stocks, ETFs for you. So taking what we've discussed against the backdrop of rate cuts, against the expectations of the economy, recession, et cetera, where do you put your money? We will be looking at different sectors, different stocks, different ETFs for you in the weeks ahead. Also looking at the impact of economic policies for the upcoming election. They are divergent, to say the least. And also investigating with you what in the software world is called an event cascade, or also known as the cascade effect. If we start to put a little logic puzzle together, we do risk a picture that doesn't look pretty. Doesn't mean that it'll happen, but readiness is all, and preparation matters most. And as I said, I'm still bullish, believe it or not. I know I feel like I'm giving bad news, but I don't feel like I am until there's a real signal, which will make evident to everybody. I still believe that we're going to avoid the worst of things, and the market will turn around and be better. So with that, I'll take a quick look and see if we had any questions here. Got that. Yeah. Thompson watching it into the close right there with us. Thanks, David. Yeah, Jeff and I really had a good time. We were riding and dying every time the SPX would run up to about the 53.30 line. And then it would pull right back down to 53.25. So it was crazy to do that. So I don't see any major open questions. Doesn't look like I'm looking anywhere. I am recording this. We will be posting the recording to our Traders Reserve YouTube channel. We'll get a link out to everybody on that tomorrow morning. And then once I get the note taker fixed, we'll have email notes going out, sort of like a Cliff's Notes version of what we've discussed here. So lots to do in the weeks ahead. Thanks everyone for joining me, and hope everyone has a better day tomorrow. Patience, and take a break tonight, and we'll get back to it tomorrow. I believe we have a 10:30 trading session for Options Income Weekly. And outside of that, thanks for joining me. Have a great night, and we'll see you again next week on IQ EEK, Monday at 4 p.m.